Welcome to Talk Tickers, your shortcut to understanding what really matters in those crucial company earnings calls.
Today, we're looking at a major player in industrial gases.
Yeah, and this latest call, well, beneath the surface numbers, it revealed a pretty significant strategic pivot.
Definitely. And some fascinating financial updates, too, which could signal where this giant is heading.
Okay, let's unpack what it all means for you.
Sounds good. So let's start with the headline figures, maybe. Second quarter.
Yeah, the Q2 numbers.
Okay, so adjusted earnings per share came in at $2.89.
Which was a miss on their guidance, right?
It was, yeah. Their previous range was $2.75 to $2.85, so a bit shy.
And volume?
Volume saw a dip, 3% decrease year over year.
Okay, but there's context there.
There is. It's important to understand that about 2/3 of that volume decline actually came from divesting their LG business.
Ah, okay. So not purely an organic drop. So while EPS and volume weren't quite there, maybe pricing tells a different story.
It does add some color, yeah.
Yeah.
If you look at pricing, the total company average was actually up 1%.
Okay.
And if you zero in on their core merchant business,
Yeah.
and this is excluding helium, which can be volatile,
Right, yeah.
they actually got a pretty healthy 3% price improvement there.
Still, operating income was down.
It was, yeah. Adjusted operating income decreased by 9%. And that really ties back to that LG divestiture we mentioned, and also lower profits from helium.
Got it. And the margin.
Operating margin took a hit too, down 210 basis points.
Right. So some headwinds in the rearview mirror. What about looking forward? What are they telling us for the rest of this year, FY25?
Well, they've revised their full year adjusted EPS guidance. The new range is $11.85 to $12.15.
And that adjustment reflects?
It reflects the impact of some project cancellations they had to make, and also just broader, macroeconomic volatility.
Yeah.
Uncertainty.
Makes sense. And for the next quarter, Q3.
For Q3, they're expecting adjusted EPS between $2 and $3.
Okay. And capital expenditure, big number there.
Yeah, they signaled a pretty significant full-year CapEx, approximately $5 billion.
That's a lot of investment. Anything else stand out from the financials? Any big charges?
Yes, actually, they booked a substantial after-tax charge in Q2. We're talking $2.3 billion.
Wow. What's in that?
It includes costs tied to those project cancellations, expenses for cost reduction efforts, and also executive separation costs.
Okay, so a lot to digest just in the numbers. Now let's really dig into the why behind this and the future direction. Sounds like the new CEO is charting a different course.
That's really the heart of it, isn't it? A major theme on the call was this clear return to their sort of foundational industrial gas business.
Back to basics.
Pretty much.
Okay.
The CEO really emphasized focusing again on securing those on-site contracts.
The ones with long-term commitments, take or pay.
Exactly. Those.
Yep.
Really locking in that demand. And also increasing density within their regional merchant gas business.
And acknowledging past moves.
Yes. Interestingly, he was quite open about acknowledging that previous strategic pivots, like into coal gasification and some clean energy investments, well, in hindsight, they'd moved the company away from its historically successful model.
And created complexity, maybe. Increased leverage.
You hit it. Increased financial leverage and also headcount. He pointed out that to support those other ventures, headcount had ballooned by about 7,000 employees since 2018.
7,000. Wow. That must have hit costs.
Definitely put pressure on the cost structure, and maybe more critically seemed to impact project execution. Quality, timing, leading to delays and those cancellations we heard about.
So how are they structuring things now? You mentioned pillars.
Yeah, they're kind of organizing the business around 3 key pillars now.
Okay, what's the first one?
Pillar 1 is that strong core industrial gas business. It's generating around $12 billion in sales annually. Already has a healthy 24% operating margin.
And room to improve.
Management thinks so, yeah. They see a big opportunity to push those margins even higher through more discipline on costs, productivity drive, strategic pricing, just operational excellence overall.
Makes sense. Lean into your strength. What are the other 2 pillars?
The second covers 2 very large, strategically important projects. One is the green ammonia project in Saudi Arabia.
Right.
And the other is the blue hydrogen project down in Louisiana.
The big bets, essentially.
That's the idea. The long-term vision is they could become, lowest cost producers globally for decades. But importantly, they see themselves as industrial gas suppliers, not retail distributors of ammonia or hydrogen.
Interesting distinction. Okay, let's dig into those 2 flagships. Saudi first, how's that progressing?
The green ammonia project in Saudi Arabia seems to be pretty much on track.
Good news there?
Yeah. They're a big investment. that 4 gigawatts of renewable power, solar and wind, that's expected to be done by mid-2026.
And then production.
Then comes commissioning the electrolyzers at the ammonia facilities. They expect product to be available for sales sometime in 2027.
And they've managed the spending.
Apparently so. They've controlled their direct CapEx exposure through partnerships and project financing. The near-term focus is just get it built, sell the green ammonia FOB Saudi Arabia.
FOB, so buyer handles shipping from there.
Exactly. And interestingly, they're deliberately holding back on further downstream investment, say in Europe, for green hydrogen.
Why is that?
Waiting until the regulatory picture and, crucially, firm customer commitments are clearer. For instance, their deal with Total for green hydrogen in Europe isn't scheduled to start until 2030. Development ramps up maybe 2027 at the earliest.
Okay, a measured approach on the downstream side for Europe. What about Louisiana? That blue hydrogen project has seen some shifts, hasn't it?
Yeah, the strategy there is decidedly more cautious now. They're actively trying to de-risk it.
De-risk how?
Specifically looking to divest or find partners for the carbon sequestration part and the ammonia production elements.
So offload some of the risk and complexity.
Precisely. The earliest startup they now see is 2028 or maybe 2029, and that's if they successfully de-risk those components.
And spending.
They were very clear. No significant new spending commitments without firm long-term offtake agreements locked in for both the hydrogen and the nitrogen.
Makes sense. Control the downside. What's the target CapEx now?
The goal is to bring the total potential CapEx down from maybe $8 billion previously down to a more manageable $5-6 billion range. They're even considering just focusing solely on H2 and nitrogen production.
De-risking is definitely the theme there. Okay, so that's pillar 2. What's the third category?
Pillar 3 is what they're calling the underperforming projects. This represents about $5 billion in already invested capital.
Ouch. What are these?
These are described as sort of first-of-a-kind energy transition projects that ran into significant cost overruns, big ones.
And maybe the market wasn't quite ready.
That seems to be part of it. In some cases, they were designed expecting to sell extra volumes into non-contracted pipelines or banking on a hydrogen mobility market that just hasn't developed as quickly as hoped.
So some tough lessons learned there. What's the plan for these now? Just write them off.
Not entirely. There's still about $2 billion left to spend on them between 2026 and 2028.
Okay.
They don't expect these to add much to operating income, but the hope or expectation is they'll generate enough positive cash flow over their lifetime to at least recover the initial cash investment, undiscounted.
So manage them for cash recovery.
Right. Focus on maximizing profitability through commercial talks, operational tweaks, productivity gains. And they did take action, cancel 3 big U.S. projects back in February.
And the cautious Louisiana approach fits this too.
Exactly. Oh, and the Edmonton Net Zero Hydrogen Project, the total cost forecast there is now $3.3 billion, with startup likely late 2027 or early 2028.
Okay, so a period of streamlining, recalibration. How does this all feed into future CapEx and headcount plans?
Well, once these major projects, Saudi, Louisiana, the underperformers are mostly done, they see annual CapEx settling around a more sustainable $2.5 billion level.
That's a big drop from the current $5 billion.
It is. And on personnel, there's a major right-sizing effort underway. The goal is to get headcount back to pre-2018 levels.
Which means going from
the current 23,000 employees down to roughly 16,000.
Wow, that's a significant reduction. Are they already doing that?
Yeah, they've started 1,300 reductions are in process, and they expect another 2,500 to 3,000 positions to be cut between 2026 and 2028, often as these big projects wind down construction phases.
Okay, big moves on efficiency and costs. So what does the financial picture look like based on all this? What's the outlook?
So for this year, 2025, they're aiming for a base business EPS around $12.
Okay.
With double-digit return on capital, ROC, and an adjusted operating margin over 20%.
And looking out further, medium term.
Medium term, say 2026 to 2029, they're targeting high single-digit adjusted EPS growth. Adjusted operating margin pushing into the high 20s, and adjusted ROC in the low to mid-teens. Importantly, they see aggregate net cash flow improving towards neutral during that time.
And longer term. 2030 and beyond?
The aspirations get bigger there, roughly 30% adjusted operating margin, mid to high adjusted ROC, and double-digit adjusted EPS growth.
Ambitious targets.
Yeah, the goal is to hit over 10% compounded EPS growth versus 2025, sometime around 2031 or 2032.
Okay. They also mentioned helium, right? That market's been a roller coaster.
It has. They acknowledge the market is currently long, oversupplied, mainly due to Russian production coming online.
How are they managing that?
They've invested in a large helium storage cavern in Texas, which helps manage the cyclicality. And while the year-over-year numbers look negative right now, their current operating income from helium is actually still way higher than it was pre-COVID.
That's an important perspective. But headwinds still expected.
Yes, they do expect pricing headwinds for helium in 2026 and 2027.
Got it. And finally, any update on those gasification projects in China?
Yeah. The combined EPS contribution from the 3 projects there was basically 0 in 2023 and 2024. Negligible?
Not great.
No. Apparently, the Luin project is the best performer of the 3. But overall, the weaker performance in their Asian segment was largely pinned on these gasification ventures.
Okay. So let's try and pull this all together. For listeners trying to make sense of this, what's the main takeaway? What should investors be focusing on?
I think the big picture, the overarching narrative, is a company very deliberately pivoting back to its core industrial gas strength.
Right. The bread and butter.
Exactly. Coupled with a serious focus on cost discipline. This whole strategic refocus signals a clear drive for better profitability, better efficiency.
And the big projects.
More pragmatic, maybe. Measured optimism on Saudi, which seems on track and has long-term potential, but balanced with that very cautious de-risking approach in Louisiana, smarter capital allocation, hopefully.
And a cost side?
The headcount reduction plan is significant. It shows they're serious about controlling costs and boosting margins. It's tough, but likely seen as necessary.
While the underperforming projects.
Yeah, those, and the write-down, they definitely highlight the risks when you venture too far outside your core, maybe.
Lessons learned, perhaps?
Seems like it. But those long-term financial targets they put out for margin, for UPS growth, they suggest management really believes they can unlock significant value by executing this new refocused strategy.
So what are the key things to watch going forward?
Progress towards positive cash flow, maybe as early as next year. That's a big one. That would open the door for deleveraging, reducing debt.
And maybe share buybacks eventually.
Potentially, yes. Returning capital to shareholders down the line. Investors will be watching execution very closely.
Okay, brings us to our This Is Not Financial Advice segment. Time for an outrageous but plausible trade idea based on all this. What have you got?
All right, here's a thought experiment. Not advice, remember.
Absolutely not financial advice.
Okay. Given this company's commitment to that Saudi green ammonia project, especially with its own low-cost renewable power behind it.
Right, potentially a very competitive long-term cost structure.
Exactly. So consider this. Go long a European fertilizer company, one that relies heavily on volatile natural gas for its ammonia production.
Okay, long European fertilizer. But there's a catch.
There's the hedge. Simultaneously, buy a long-dated put option on that same European fertilizer company.
Ah, okay. Explain the thinking there.
The logic is, as that Saudi green ammonia starts hitting the market, likely around 2027, its potential cost advantage could really start squeezing the margins of those European producers tied to natural gas prices.
So the long position benefits if the market doesn't see it coming yet, or if the fertilizer market stays strong for other reasons.
Right, but the long put option acts as your insurance. It protects you if or when that cost pressure from cheaper green ammonia really bites, or if the timing is different, or other factors hit the fertilizer market.
So betting on a structural cost shift, disrupting the incumbents, but hedging the timing and execution risk.
That's the idea. Purely speculative, based on potential future dynamics. Do your own homework, obviously.
A very interesting thought experiment. Well, that wraps up our deep dive for talk tickers on this industrial gases earnings call.
Yeah, clear story of returning to the core, a more cautious approach to big projects, and a big push on efficiency.
Definitely. The road ahead involves navigating those past project challenges while really trying to capitalize on the core business strengths and, of course, that strategic Saudi investment.
It'll be fascinating to watch how it unfolds.
So what are your thoughts on this strategic shift? What risks and opportunities jump out at you? We'd love to hear them. Join the conversation.
Thanks for tuning in to Talk Tickers.
Until our next earnings call breakdown, keep your analysis sharp.